Welcome to the deep dive. We're going straight to the core of the markets today, cutting the line, really, to the public exchanges and diving into one of the most, well, compelling but also restricted asset classes out there, pre-IPO investing on secondary marketplaces.
Yeah, it's a fascinating space.
For the investor looking for a unique opportunity, this feels like the new frontier. It's almost a shortcut, right? To get access to these high-growth companies, the famous unicorns, before they hit the NASDAQ Q bell. If you're trying to track where, the real wealth creation is happening today, often the answer seems to be behind these velvet ropes of the private secondary market.
And that's exactly what we need to sort of illuminate here. Our mission today is simple: give you a complete, clear picture. We're going to unpack the specific mechanics of how this market works, understand the huge structural shifts that even created this opportunity in the first place, and crucially, identify exactly what the unique risks are, but also the potential rewards for a sophisticated player, thinking about entering this space.
Okay, so let's unpack this then. The fundamental question first. Why now? Why are we even having this conversation? What's changed that makes these super valuable companies stay private for so long?
It really boils down to a massive shift, almost a tectonic shift in corporate finance. It's completely changed the, let's say, the traditional timeline for growth. Historically, right, you needed that big IPO. It was essential to inject serious capital to grow aggressively.
But that's just not the case anymore.
Not really, no.
And there's a stat that really drives this home. Between 1996 and 2016, the number of U.S.-listed companies actually fell by 52%.
Wow.
52%. Just think about that. Half the companies that would have gone public back then are now staying private.
It's a total reversal.
Yeah.
And the implications of that shift for the secondary market, huge. Basically, the growth phase, the really explosive part that used to happen after the IPO, it's now happening before it.
Because there's just so much private money sloshing around.
Exactly.
Yeah.
This massive flood of private capital, from VCs, private equity, sovereign wealth funds, it lets these billion-dollar unicorns raise billions without ever dealing with the cost, the regulation, the public scrutiny.
All the stuff that comes with an IPO.
Right. They just don't need it as early.
So this is why the secondary market suddenly becomes so important. And just to be clear, we're deliberately setting aside that really early stage stuff, seed, Series A.
Oh, yeah.
Which is, let's be honest, often high-risk speculation. We're talking about that sweet spot, late stage, pre-IPO.
Precisely. These are typically companies maybe 1 to 4 years away from a potential exit. They've got proven business models, they have customers, revenue. They're focused purely on scaling up now, not just surviving.
Yeah.
And that fundamentally changes the whole risk-reward calculation.
Yeah.
You're investing in growth, not just hoping an idea takes off.
Okay. And when we talk about getting shares in these private companies, we need to be clear about where those shares actually come from. Two main sources, right?
The source matters, yeah, a lot. First, you've got primary placements. That's the company itself issuing new shares.
So the money goes to the company.
Right, straight onto their balance sheet to fuel growth.
Yeah.
But those deals, almost always reserved for the really big guys, the institutions.
Okay, so not really accessible for most individual investors, even accredited ones.
Generally not directly, no. So our focus really is the secondary market transaction. This is different. Here the company isn't raising money at all. These shares are being sold by existing shareholders. Think early employees, angel investors, maybe even some VCs who want to cash out a bit early.
Solving the paper wealth problem.
Exactly. The proceeds go straight to the seller. It unlocks that value that's just sitting there, trapped in illiquid private stock.
So that trapped wealth creates the supply. If I'm an early employee sitting on potentially millions in stock I can't touch, I'm motivated to sell on this secondary market.
You are.
But it's not like buying Apple stock. You can't just log into your brokerage. What's the main barrier, the big regulatory hurdle keeping most people out?
That's the accredited investor standard. It's the key gatekeeper, enforced by the SEC. Rule 501 of Regulation D specifically. Accessing these private, unregistered securities. Legally, it's seen as a privilege, not a right. The SEC's rationale is basically only people who can truly understand the risks or afford a total loss should be playing in these less transparent markets.
Okay, so for an individual, a natural person, as they say, how do you actually prove you meet that standard? There are 3 main ways, but you just need one.
Correct, just one. The most common is the income test. You need to have earned over $200,000 yourself or $300,000 with your spouse in each of the last 2 years.
And expect to keep earning it.
Yes. Crucially, you need a reasonable expectation of reaching that same level in the current year. And you have to be consistent in how you calculate it, individual or joint.
Then there's the net worth test. This is where people sometimes get tripped up, I hear.
They do. The threshold is over $1 million in net worth, either alone or jointly with a spouse. But here's the non-negotiable part. You must exclude the value of your primary residence.
Your main home doesn't count.
Correct. And you also exclude the debt secured by that home, unless the debt is actually more than the home's value.
Right.
The idea is to prevent people from qualifying just because they live in an expensive house with a big mortgage.
Right. It's about having actual liquid assets or investments beyond your home equity. And the third way, this one's newer, recognizing that money isn't the only sign of sophistication.
That's right, expanded in 2020. It's the professional sophistication test. You can qualify if you hold certain professional financial licenses, Series 7, 65, or 82 are the common ones. Or there's a category for being a knowledgeable employee of a private fund, meaning your job gives you the necessary expertise.
And it's not just ticking a box on a website, right? The platforms have to verify this.
Oh yeah, they have a legal obligation to take reasonable steps to verify your status. They carry the liability if they let someone unqualified in.
So what does that look like practically, sending tax returns?
It can mean submitting things like tax returns, W-2s, maybe bank or brokerage statements showing assets. Probably the cleanest, often quickest way is to get a verification letter from a third party, like your CPA or an attorney, confirming you meet the standard.
Okay, so the SEC calls this investor protection, which makes sense given the lack of public disclosure. But as we noted, it does limit the opportunity for, well, almost everyone else.
It does, and that's the fascinating tension here. The intention is protection, absolutely. These are opaque, illiquid markets. But the practical outcome, it effectively creates a two-tiered investment system. The general public is largely walled off from what's often the highest growth phase of these successful companies.
They only get in after the IPO.
Exactly, when a lot of that exponential growth might have already happened. They're essentially getting access later in the game.
Okay, so let's say you do qualify. You're accredited. Now you need a place to actually make these investments. And this is where it gets really interesting. The platforms themselves aren't all the same.
Not at all. They have pretty different models, fees, minimums. You need to understand how each one operates.
Let's compare the big four. Start with Forge Global. What's their approach?
Okay, Forge. They're one of the biggest players. They operate largely on a broker-driven model. Think high volume, connecting buyers and sellers. A key thing they offer is their proprietary Forge price-head data, which tries to bring some transparency to valuations in this pretty murky market.
And for the investor, what are the typical terms?
Because they're often dealing in larger blocks via brokers, the typical direct minimum investment is around $100,000. And fees are usually charged to both the buyer and the seller, often in the range of 2% to 4% each.
Right. Next up, EquityZen. They're known for a different structure, the SPV, right? Special Purpose Vehicle. What does that mean?
Yeah, EquityZen really pioneered this for broader access. With the SPV model, you, the investor, aren't buying the shares directly. You're buying an interest in a fund, the SPV, and that fund holds the actual shares of the private company.
Why do it that way?
Well, for the private company, it's much cleaner. Instead of adding potentially hundreds of small investors to their cap table, they just see one entry, the EquityZen fund.
Simplifies things for them. And for the investor, what's the trade-off?
The big advantage is a much lower entry point. Their minimums can start as low as $10,000 for investing in a single company SPV. That's a key differentiator.
Okay, much more accessible. Downsides.
Well, you're investing in a fund structure, so expect things like K-1 tax forms, which can be more complex. And your access is sort of filtered through that SPV manager. Fees are typically a one-time sales fee, tiered, maybe around 5% for investments up to $500,000.
Got it. Then there's Hiive. Their model feels more like a traditional stock exchange.
That's exactly the idea. Hiive aims for an exchange-like model with an anonymous order book. The focus is squarely on price transparency and price discovery, letting buyers and sellers post bids and asks.
And their fee structure is quite different, I understand.
Very different and quite strategic. Their key differentiator. Buyers typically pay no fees on direct trades. The seller pays the commission, usually around 4% to 5%.
That's a big incentive for buyers to come to their platform.
Absolutely. It's designed to attract liquidity and make it easier for buyers to participate. Their minimum transaction size is usually around $25,000.
Okay. And the fourth one, Upmarket.
Upmarket positions itself a bit broader as a diversified alternatives platform. So alongside pre-IPO deals, they might offer access to real estate, crypto funds, things like that.
So more of a general alternative investments hub.
Seems that way. Their minimum is typically $50,000. The source material we looked at was a bit less specific on their exact fee structure, just advising investors to, quote, evaluate fees and their impact on returns. So you'd need to dig into that.
Okay, so the choice really depends on what you prioritize. Lowest entry, maybe EquityZen, price transparency, and potentially no buyer fees. Hiive seems like the play.
Exactly. Your goal shapes your platform choice. Now, let's talk about the actual trade. Doing the deal itself, because there are some serious friction points here.
Right, due diligence must be tough. These aren't public companies filing quarterly reports. Information is scarce.
It really is. You have to piece together what our sources call the mosaic of information. You're looking at public filings, if any exist, news reports, funding history, and critically, you look at the quality of the existing investors. If you see top-tier VCs like Sequoia or Andreessen Horowitz already in the deal, that's a strong signal.
A proxy for quality.
Okay. It suggests that really sophisticated players have already done deep dives and believe in the company.
But even after you've done your homework, found a seller, agreed on a price, there's one huge potential roadblock, the ROFR, the right of first refusal. Explain that power dynamic.
The ROFR. This is the company's ultimate trump card. Basically, after a buyer and seller on the secondary market agree on terms, the private company itself has the contractual right to step in.
Step in how?
They can intercept the deal. They can choose to buy the shares themselves at the exact same price you agreed upon with the seller.
Wow, so they can just block outsiders they don't want.
Exactly. It's their way to control who gets onto their cap table. And it's the single biggest source of uncertainty in these transactions.
And it happens reasonably often. I saw a note from Hiive suggesting their ROFR rate actually went up recently.
Yeah, that was interesting. Hive noted it increased from about 12% in 2023 to 18% in early 2024.
18%. So nearly 1 in 5 deals gets intercepted by the company after you've done all the work. What does that signal?
It could signal a couple of things. Maybe companies are getting more protective of their cap table as they get closer to an IPO.
Yeah.
Or maybe they see the price agreed upon as a bargain and decide to buy back their own shares cheap.
Either way, it adds significant delay and uncertainty for the buyer.
Definitely lengthens the process and adds friction. It underlines that this is not an efficient market like the NYSE. The company holds a lot of power.
Okay, let's shift from that kind of friction to structural risk. You mentioned earlier that secondary buyers are usually getting common stock, the same stuff employees get. How does that differ from what the big VCs hold?
This is absolutely critical. Huge difference. Common stock is, frankly, inferior to the preferred stock that VCs almost always negotiate for.
Inferior how?
Preferred stock usually comes with special rights. The most important one is often a liquidation preference,
Meaning?
meaning if the company gets sold or liquidates, especially at a valuation lower than expected, which happens a lot, the preferred stockholders, the VCs, get their money back first, sometimes even multiples of their investment, before the common stockholders see a dime.
Wait, so I, as a secondary buyer who paid cash for common stock, could literally get zero back if the final exit price isn't high enough to cover those preferences first.
That is absolutely the risk. It happens. Your entire investment could be wiped out while the VCs still get paid.
That completely changes the risk calculation. Common stock is truly unprotected in that downside scenario.
Precisely. Always remember, preferred has protections, common generally does not.
Okay, and then there's the risk that hits after a successful IPO, the one people often learn the hard way, the post-IPO lockup trap. Let's walk through that cautionary tale.
This one is brutal because it mixes bad market timing with tax law. So the company finally goes public, yay, but your shares, bought on the secondary market, are typically subject to a lockup period, usually 90 to 180 days.
Meaning you can't sell even if the stock price is soaring right after the IPO.
Exactly, you're locked in. Now imagine this real-world scenario we heard about. An employee's shares IPO at $85, huge paper gain, life-changing money. But the lockup lasts, say, 90 days. During those 90 days, the market turns, the stock crashes. By the time the lockup ends, the stock is only worth $45.
Okay, painful, but they still made money compared to their option price, right? But here's the killer. The taxes.
This is the trap. Their income tax liability wasn't based on the $45 they could finally sell at. It was based on the value when the shares vested or were recognized, often tied to that $85 IPO price.
So they owed ordinary income tax on $85 per share, even though half that value had vanished before they could even sell.
Correct. They got hit with a massive tax bill on wealth that had evaporated. Imagine owing taxes on money you no longer have. It can be financially devastating.
That truly highlights the difference between paper wealth and real realized cash. Until you sell and the money's in your account, that valuation is just theoretical.
And the tax authorities don't care about theoretical. They care about the value at the taxable event.
So pulling this together, a pre-IPO offers this potential for asymmetric returns, right? Catching huge growth, maybe at a discount. But it carries these very real risks. Illiquidity, information scarcity, ROFRs, share class risk, potential total loss, the lockup trap. How do you even approach managing that?
There's really only one reliable strategy, the only thing resembling a free lunch in this market: diversification.
Don't put all your eggs in one unicorn basket.
Absolutely not. You cannot reliably pick the one winner in a market where, even at the late stage, companies still fail or underperform. Failure is part of the model. So you need to diversify across multiple dimensions. Spread your capital across different companies, obviously, across different hot sectors, maybe some AI, some fintech, some biotech, and also across vintages or stages. Don't just buy Series F companies. Mix in some Series D or E as well. The whole goal is portfolio construction.
You're trying to ensure that the gains from your one or two big winners, the 10x or 20x returns, are enough to cover the inevitable losses from the others that don't pan out.
That's the strategy in a nutshell. Capture the outliers.
And finally, let's just hammer home the holding constraints. This isn't day trading.
Not even close. Illiquidity is probably the single biggest risk factor you need to accept. You have to be prepared for your capital to be locked up for potentially 5 to 10 years, maybe longer.
A decade. Wow.
It can happen, and compounding that is SEC Rule 144. For restricted shares bought in a private company, there's a mandatory 1-year holding period after you've fully paid for them before you can resell them, even privately.
So even if you find another buyer willing to take them off your hands after 6 months, you legally can't sell.
Correct. That 1-year clock has to run out first for non-reporting private companies. It just cements the fact that this is a long-term, patient game. It demands disciplined capital you won't need anytime soon.
So the big takeaway here seems to be success demands patience, serious diligence, diversification, and crucially, understanding that paper wealth in this market is highly misleading until you actually have the cash. You've got to survive until realization.
Absolutely. And maybe one final thought for you to consider looking ahead. The whole future viability and vibrancy of this private secondary market really hinges on two big cyclical factors. First, regulatory evolution. How might the accredited investor definition change? That's a constant debate in DC. Any changes there could dramatically expand or contract the market. And second, maybe even more importantly day to day, is its sensitivity to macroeconomic conditions. If the broader market tanks, if interest rates stay persistently high, that IPO window can slam shut.
Meaning no exits.
Meaning liquidity completely freezes up. If companies can't go public, the primary way for secondary investors to cash out disappears. You could be left stranded holding illiquid stock for years longer than planned. There's deep dependence on public market sentiment for exit liquidity. That's the ultimate long-term cyclical risk everyone in this space has to watch.